I'm just going to talk to you.
Let's do it. We're live.
I think how we do it. That's how we should do it. So I don't know if you heard about this, Joe, but the FDIC filed a complaint against some of the officers and the directors from SVB. So you remember SVB, Silicon Valley Bank? Mm-hmm. That's the one that collapsed back in, I think it was like March or whatever, 2023. And
this was the biggest bank failure since Lehman Brothers.
Yeah. So it's over $200 billion bank. And very big deal. And they went down. And I think kind of where this is coming from is at its core, people want to see they want blood, I think, in general, for when something like this happens. This bank was not bailed out, although people want to, I think the spirit comes from, they want to see some people get held accountable for this. Mm-hmm. So this is, SVB, Silicon Valley Bank, it's based out of California. So kind of the politics there are also one way or the other. But regardless, regardless of where your politics lie, you can try to put that aside and we can just look at the complaint. I'm thinking I can go through it and we can then kind of decide whether or not there's a real case here. And, in the process, we can learn a little bit about finance, banking, interest rate risk, liquidity risk, how banks are structured internally, just with the governance, what their processes are, what the risk management is like. And, although you know about this already, we can kind of give it to the audience or anyone interested. Yeah. So this is the case. And it was filed. Where's the date? Okay. So this is the case. It was filed just on the 16th. It's the 23rd now. So this is pretty fresh. And, let's see what the prosecution says. Basically what they want to do is they want to show that the SVB represents a case of egregious mismanagement of interest rate and liquidity risks by the bank's former officers and directors.
They really come out swinging up front.
They're going to come out swinging. So the language in this, again, you got to read that this is not an unbiased participant. This is the prosecution. So they're going to ratchet this up as far as it can possibly go. When I was reading through it, I think I found a couple of things that I thought they took a little step too far. That wasn't totally accurate. But let's see. I highlighted some good stuff in here. So we got the parties, the plaintiffs, that's the FDIC. So it's a bank regulator. And the defendant, that's going to be they listing out all the individual, essentially the C-suite. Those are the officers. And then the directors, so the board of directors. That's all of them listed here. And they provide this really useful chart. So they give you a table, I should say, of the individual names, what their title was, and then what committees they sit on. So I think it's important, people watching, this isn't totally obvious to everyone on the outside. But the way governance in a bank is structured is you're going to have like a board of directors. That's going to be that's going to be the tippy top. And they're ultimately responsible for the risk and the overall driving of the strategy. So the board of directors also is supposed to be a corporate structure solution to the principal agent problem. So you can imagine the agents, those are going to be the CEO and the CFO and the people who actively, manage the bank. And then the principals are the ones who actually own the bank. So those are the shareholders. Now, sometimes those incentives don't always align. So like a CEO or something, CEO might be more interested in kind of their own personal career. They might be interested in, making a lot of money really quickly. And in doing so, that incentive to make a lot of money really quickly might not be aligned with the overall health of the company, for example. Now, the board of directors is supposed to oversee the CEO and what, he or she is doing, and to align their incentives, make sure that theirs aligns with the shareholders.
Knock some heads around whenever they need to.
Yeah. So A board of directors should be able to, for example, fire the CEO. They should be independent, should be knowledgeable. So when they're talking about officers, that's the actual management of the bank. And then the directors, they don't show up for work every day. What they're going to do, they're going to have board meetings. They might have, I don't know, 10 a year or something, maybe one a quarter, something like that, in which management, who is actually there every day, and they show up to work every day, goes to them and says, look, this is what's happened. These are sort of the risks. This is what we intend to do about it. And then the board will say yes or no. We agree with that or we don't. But ultimately, it's the officers, so the CEO, CFO, CRO, that goes to them and convinces them to do one thing or the other. Now, the last thing here, just in terms of the governance of a bank, is the committees. So the ALCO committee, you can see, is listed here, in which a bunch of these executives sit on. So the ALCO, that's the Asset Liability Management Committee. And what that's responsible for is some of the core risks of a bank. So it's going to be liquidity risk is managed at ALCO, interest rate risk is managed at ALCO, talk about capital, investment portfolio, if you want to buy and sell securities, those sort of details and decisions are going to be held at ALCO. ALCO is usually chaired by the treasurer, and the treasurer is kind of the owner of the balance sheet, so to speak. And under the treasurer, a lot of the risks are going to be actively managed by him or her. Now, ALCO is going to be a management committee. So those are, the board of directors is not involved in ALCO. At a higher level, the board is going to have its own set of committees. And they list two here. These are sort of the two relevant ones to this case, is the finance committee and the risk committee. So those are going to be, and they're going to be a bunch of people from the board of directors that sit on it. Now down here, they go into a little bit of, I'll kind of mention it down here. They go into a little bit of detail as to what each of those committees are responsible for. So, the finance committee. So again, this is a board committee, which the board of directors they sit on. They are to oversee, according to the charter. Every committee will have a charter, which explains who sits on it and what they do. And the finance committee, they say, is supposed to see certain corporate strategic matters, financial performance is reviewed, the capital planning, the stress testing, capital liquidity management, stuff like that. And, I won't go into detail here. You can read it, but you can imagine that the other committees will look into the other risks of the bank. Yeah. Okay. One of the things that they mentioned here, that the lawsuit mentioned here, and I wanted to get your take on this, was the writer is giving me the impression when it says here since at least 2021, so SVB FG and SVB'S, so that's going to be the holding company and then the bank itself. So a lot of banks are structured this way, in which there's a holding company and the actual bank is below it. They do this for several reasons. A lot of it is kind of to facilitate maybe capital actions. So buying and selling stock, issuing debt might happen at the holding company level, things like that. There are reasons for it. But what the writer sort of here is writing, or I should say, if you read this, it sounds as though the board of directors overlapped completely of both the holding company and the bank, and that is each member of the holding company's board of directors was also a member of SVB's board of directors and vice versa. Which kind of, when you read this, you are looking for a reason for it to be in here. So it almost as though it suggests that that's wrong, or like it shouldn't be the case. When I think just the fact that it's adding that nothing burger is a little bit misleading and a little bit manipulative, because it's implying that it's wrong, when in fact it's just it's not an empty shell, but it's just a holding company. There's no real decisions going on there.
Yeah. It's like it's kind of treating it as if these two entities are like
Yeah,
independent items that shouldn't be working together, but
but this is
implicit
common
intent
practice.
is
There's
to.
nothing strange
Yeah.
about this. There's nothing like sneaky going on here, even though it's
Hmm.
kind of feeling like it's giving that impression. So when I
Hmm.
read this, that's one thing that was kind of bothering me. It feels a little lawyered up. It feels a little
Right.
manipulative.
And then like somewhere else, I think on the page before or after, like it goes into the amount of assets held by each.
Yeah,
Something
here
like,
as of year
oh
end,
yeah, right.
it's billion total assets, 98.67% of
Yeah,
the assets is the bank. It's like, yeah, that's what
that's
it's
what
fine.
it does.
It's yeah. Um, so I wanted to mention kind of my
Yeah, just
take.
is
My
that
take
kind of
there.
like
It's a
preamble
nothing.
there,
It's a nothing burger.
right?
Um, okay. Um, so now we're kind of getting in some of the meat of what was happening at the time. So it says the first part here is to point out the incredible growth that happened at SVB. So they say at the beginning of 2018 they had about 56 billion in assets, which is still a pretty big bank. It's nothing to shy away from. Um, and then it says by the end of 2019 it had 70 billion in total assets. And then between 2020 and 2021, it tripled its assets. So, you know, by 2020, their assets nearly doubled to 111 billion, and by the end of 2021, it had 209 billion.
Hmm.
That is crazy. That growth, that is nuts. And
Yeah, I mean, I would say though, it's like my immediate reaction to that. The counterpoint is that the total money supply roughly doubled over that time period.
right, so that's the thing. It's like what fueled that, and you can see, 2020 and 2021, sort of I wrote here. Liquidity was totally jacked up in the market after COVID. So you can imagine, a lot of their people in the Bay Area, I think a lot of them were businesses or tech or something. They were
Mhm.
incredibly flush with liquidity and they had to
Mhm.
deposit it somewhere.
Yeah, I think the Fed added something like $4 trillion to the overall system.
Yeah. In
Just an
fact,
incredible amount of new money that
uh,
just appeared over the course of uh, a few months during the majority of which was over the first half of 2020.
right. Here we go. Um, yeah. So like what you're seeing, that growth is like
Yeah,
right here.
that's it.
Bam.
Hmm.
Yeah. That is insane. So, you can kind of zoom in and you can almost right here. So I don't think this is a coincidence here. The fact that in 2020 and 2021 that this bank saw some ridiculous growth.
Hmm.
It's just because the amount of deposits and cash in the system was just jacked up during COVID,
Hmm.
which was a government directed program.
Yeah,
Um,
it was a combination of
yeah.
Fed programs, which like the Fed lends to institutions and companies, of which then pay people, whereas the government can pay people directly via tax rebates or even just we saw over COVID just stimulus checks. But both of them were doing it simultaneously.
There's like PPP loans. I think that was a huge deal,
Right.
which was
Right.
essentially just checks written out to businesses that they were going to be forgiven. It was just free money.
Hmm.
Um,
That would actually be kind of a fun topic, maybe another day to do. Like I saw some random things where, like examples of certain PPP forms that were filled out
oh
with
my
just
god,
some like,
the amount of I think personally the amount of fraud in PPP was outrageous. They just saw free money and they were right and they just applied
and
and
they
they got
did.
it
And
and it was
people were
forgiven. That's what it
getting,
was.
what was it, $20,000, $50,000, and it's like fine print says, oh, you have to pay this back, blah blah blah. But someone who fills out their company name like my best company 2000, it's just like totally nonsensical, obviously made up things, and then just getting the check for it. Like, I don't think that
Yeah.
person's gonna care.
So that's a whole other thing. But I think the
Yeah.
point here is, this arguably is one of the reasons why SVB failed.
Hmm.
So you know what
Cash
is
spigot was
another thing
on.
we can blame the government on, Joe.
Yeah.
But in all seriousness, that is what precipitated all the what ended up being all their problems. They just had an incredible amount of liquidity, so deposits. They just had a whole bunch of cash they needed to do something with.
Hmm. Billions of dollars, like 100 billion new dollars.
Yeah, yeah, literally tens of billions, over
Yeah.
100 billion of just cash that they had to do something with.
Yeah. And like from that context, it's not really that easy to, dispense of $100 billion. Like
No,
you can't
they
just
didn't. They
order
didn't have like
cash.
the loan. The loan demand wasn't there.
Yeah.
And
Because the government
cash
had
at
that
that
covered.
time. Yeah, cash at that time. I think rates started creeping up in the beginning of what, 2022.
Yeah. March 22,
So
which was like a full year,
yeah,
almost 2 years since the
yeah, in
cash craze kicked
2021,
off.
cash was earning you zero. It was nothing. You had to do something with it. It wasn't
Yeah.
earning you
Interest
anything.
rates were at zero. There was nowhere to keep it. The like banks are what hold this capital, and they need some sort of investment vehicle to hold it. They have to pay their depositors something. So as a result, they need to earn something beyond that. And it's not so easy to spend $100 billion in a
Yeah.
relatively short period of time. So what
So
do you do?
moving on here. So what they did was they invested it in treasuries, but we're going to get to that in a sec. Um, the other thing kind of important here is SVB's deposits were uninsured because they exceeded the 250,000 threshold for FDIC deposit insurance. I don't know if a lot of people understand or know this, but banks, they pay a premium in order to insure deposits for everything up through, by individual account
Mm-hmm.
up to $250,000. And what they're saying here is that the majority of SVB's deposits were uninsured. They exceeded that much. So they had a whole bunch of clients that had very large accounts with them in excess of
Mm-hmm.
250,000. And everything
And that was
beyond
largely
200.
because like they primarily catered to like business corporate clients.
Yeah. I think a
Okay,
lot of
right.
it's like Silicon Valley. So it's a lot of like
Right.
startups and stuff.
So these are like company accounts that could reasonably have millions of dollars in them
Yeah.
because it's dealing
Easily.
with company payments.
Yep.
Not like individuals holding $10 million
Yeah,
in
I mean,
cash.
this is crazy. I can just tell you, kind of from my own experience, in looking at this. But to say that approximately 94% of the deposits were uninsured is nuts. Um, that is, I mean, you got some big clients. You got some big clients, and a lot of them. And what this means, kind of in the speech here, or from like a liquidity perspective, you can arguably say that when these depositors start questioning your bank, they're more likely to leave, which is to say those deposits are not sticky. That's the word that they use. They're
Mhm.
gonna fly out if something starts smelling a little funny at your bank because it's not
If
insured.
you're confident your bank is going to be there and have your cash whenever you want it, you'll be sticky. If not, see you later.
Yep. Okay. So then what happened was they're sitting on this whole bunch of cash. SVB invested the surge of the deposits in long-term fixed rate, government-backed debt securities. Okay, so just think long-term fixed securities, treasuries, mortgage-backed securities. During this time, the interest rate that you can get on those securities were not very high, but it was better than zero, which is what they were earning before. But this is sort of the key thing, what everything is talking about here. The investment strategy, when you do something like that, it exposes you to what they've written here is interest rate risk. And this is something that the, ALCO, the Asset Liability Management Committee, is something that they manage. They're supposed to track this. And what they're describing here, one of the key components of an interest rate risk management is to ask the question that if interest rates were to rise, what happens to the balance sheet? What happens to our income statement? That's what you do. And then if you say, okay, it's going to rise, let's just shock it up. Let's just shock all the interest rates along the yield curve. So the short-term rates, the mid and the long-term rates, and you shock it up 100 basis points. So like 1%. And you compare that to if rates did not move. What you're going to see is that your income, so what's called your net interest income, is going to either go up or it's going to go down. And it's going to go up or down by a certain percentage point, a certain percentage amount. What you're saying is you are exposed now to to you're exposed to rates potentially going up.
Mm-hmm.
Because you can imagine if they do go up, then you have all these securities and they are not going to reprice, but things on the liability side, they are going to reprice.
Well, not necessarily, right? Like whenever interest rates rise, if you're holding all these treasuries, again with this inverse price yield relationship, if what you're holding yield, if the securities that you're holding yield goes up suddenly, but you bought it at a different yield, the price is going down to facilitate that higher yield. So you bought it, maybe $100. Yields are going up because of the Fed is doing something, the economy's changing. That means that the price of that bond has to go down now. Maybe it's $90. So now you're realizing some potentially material loss on the underlying value of that asset.
You know what I'm thinking? I'm thinking this is going to be this is kind of what I was worried about. Would we go into this like side
maybe we can just kind of gloss.
I think
over
we should like cut. I think we should gloss all over this.
Yeah, I agree.
Because
to the case. Yeah, that was totally me taking us down the being a little
there is like so yeah. What I've written here.
Yeah, so it's interesting because it's saying that engaging in this investment strategy exposes it to this large interest rate risk. It almost characterizes it like they were being reckless.
Maybe let's. So, I think one of the things we're struggling with here is like to know who our audience is. Like, should we cater this to other financial professionals, or should we cater this to just everyone else? And I'm almost tempted to cater it to other financial professionals and do like a weekly roundup of stuff that someone who works in like a markets position or a treasury position kind of needs to know, because that's something I don't feel like I do enough of.
Mm-hmm.
And then you can talk about this a little bit differently. Then I could talk about this as I just like normally would. And so I would skip over trying to explain what all this severe interest rate risk and what that means. And I would point to just a couple things that I thought was what stood out to me personally. And when I was reading this, I said, okay, the investment strategy exposed SVB to severe interest rate risk. And, of which they were fully on notice. And so when you first read that, there are a lot of assumptions here that need to take place, because it's very possible we don't know what the liabilities look like. We don't know, as of the writing here, what the rest of the balance sheet looked like. It could have been extremely prudent for them to put on fixed rate, long-term fixed rate assets, depending on what was happening on the liability side. But this point, there are two concepts here, which they're not really explaining, I think, particularly well. There's the EV, they explain it later, but as of now, it's not here. So there's the EVE component, the economic value of equity. And in that's sort of touching upon the long-term securities decline in value. But most of the time when people are talking about interest rate risk, what they're referring to is what's happening to NII, so net interest income. And they want to know that if interest rates rise, what happens to my net interest income, which basically is the interest that you earn from your asset side minus the interest that you have to pay on the liabilities. It's that delta. Now, obviously for a bank, that's like super important, because that's the bulk of where you're going to get most of your money to pay for your non-interest expenses like salary. So it's a super important number.
That's what a bank does, right? That's
what a bank does. NII is super important. Now, most of the time when people talk about interest rate risk, what they're talking about is NII. In my experience, they're talking about NII. That's what they really care about. Your earnings, how much more money you're going to get in if interest rates go up. Now, what you're sort of referring to with the concept of prices and stuff touches upon the EVE, and that's what the issue was. It was the EVE. It was not the NII, and they have disclosures in their from the SEC filings, you can see that the bank was well positioned from an NII perspective, which is to say in 2020, in 2021, all banks should have been what's called asset sensitive, which is to say that if interest rates rise, the bank is going to earn more NII. That's what it means. That's sort of what you're interested in. And the bank was properly positioned. So according to their disclosures, according to the interest rate risk models, they would run a shock. So they said interest rates go up by 1%, 1 percentage point, 2 percentage points. What happens to my net interest income? Oh, it also rises. That's what we want. And the reason why I can do that is, even though they have a securities portfolio that's a lot of fixed rate assets, I don't know, maybe a lot of them were coming due, so they could reprice at the higher interest rate. Maybe most of their loans were, they were floating rate loans. Maybe they were shorter term loans on the asset side. Maybe the liabilities, maybe those were just like really long-term fixed for whatever reason, or maybe that's how they deposit. That's how like their deposit models were done. I don't know. But the point is, what they're writing here is like a super zoomed in look into EVE. And the other sentence sort of bothered me too. So the first half I mentioned, in a rising interest rate environment, long-term securities decline in value. Well, yes, that's always the case, but from an interest rate perspective, that's the other part of that is, well, yes, long-term securities decline in value. That's happening on your asset side, but that's also happening on the liability side. So, like in the EVE world, just because the market value, whatever your assets or some of your assets are going down, it doesn't also mean that the present value or the market value, your liabilities aren't also contracting. And it's just the rate at which each of the side is contracting at what speed that you get the change in the EVE. But the other thing that bothered me was this talk about in a rising interest rate environment, and then it says long-term securities decline in value and compress net interest margin. So they're saying that those are unrelated. Just the decline, the securities decline in value is not what compresses your interest rate margin. It doesn't touch it. We're talking about a market value on your books versus, right? So that's a stock. That's what's happening on your balance sheet relative to a flow, which is what the net interest margin is really measuring. So it's, how much net interest income, are you earning over a period of time divided by your average earning assets. Now, the thing is, in a rising rate environment, what tends to happen is that the bank's NIM, net interest margin, expands. Okay, so it's not an issue. In my take, when I read this, is, this is maybe a lawyer who didn't maybe interviewed a couple bankers or something, or they're trying to put this together and they're not quite fitting all the pieces together properly. That's kind of how I read this. Because they explain the interest margin. That's basically what this is in parentheses, but it doesn't totally connect up with the previous half. You follow me so far? Kind of.
I am with you.
This might be
a little bit esoteric.
It is very, this is in the depths of, only people who actually run these models, like I've done this,
right?
Would catch this.
Right.
Maybe.
Yeah, no,
I guess.
I'm familiar with all these concepts you're talking about, but to be honest, I really don't have a great grasp at all on how they fit together. This.
Oh, okay. Good. Okay.
You could be you could have prudent management with regards to your NII, but not in some other area. And so if you're this prosecutor, you can just kind of zero in on the area that makes your argument look the best, is kind of what.
Well, but what I'm saying is it's not really it's not an accurate statement.
Okay.
What they're writing here, they're unrelated. So, so I'm starting to have second thoughts about this episode.
Yeah, this is a big topic because, like,
It's a
we could
big
do a
deal.
topic
Like
in itself about SVB because
what's that?
it's or like we could have a whole hour-long conversation just
Yeah,
on the event itself,
yeah,
which I think would be a pretty good episode because this is still relatively recent.
yeah. Especially considering this coming in. So maybe we'll kind of edit this to just be like my take talking to another finance professional. But the other thing about this is like you are a finance professional, but this is like so specific
Right.
that even you would need
Mhm.
some sort of
Yeah, no, I
explanation
mean,
around the
this
different
is
things.
not
No,
like,
there's no reason anyone should know what EVE is.
yeah,
Let's face it.
it's very in the weeds, and so,
Very much in the
but
weeds, and I'm just starting to realize that right now. I mean, this is what I do every day. This is like
yeah, definitely,
it's
it's like
isn't
second nature.
okay. Okay. I don't know how I'm going to edit
Yeah,
this, but this is useful. I know you said
yeah,
you had to go at 7:30,
maybe like yes, I do
but
need to go
hopefully
soon,
this
but
is like super interesting anyway to you.
yeah, no, I mean,
Um,
definitely, definitely it is. So maybe, but like for the purpose of this episode, do you want to try to like wrap it, or not wrap it up, but kind of have an exit point here where we just kind of talk about like something you
yeah.
said earlier, I think over email or text, I forget, but like is the more general question of like, should someone like the FDIC trying to be like try to hold executives accountable?
Yeah. What I was trying to do was to go through kind of their case,
Hmm.
give you my angle, sort of provide that sort of extra context. So this one
Hmm.
being like, listen, this is how, there's nothing if I don't know, someone if a non-finance professional would ever read this, they'd be like, holy shit, you
Hmm.
got a great case. But what I would like to do is go
Right.
through it, kind of give you some extra color from the perspective of somebody actually in the industry,
Hmm.
and sort of explain where they might have overstepped what is kind of what's reasonable to blame someone for. So like earlier, the suggestion that having two separate boards for the
Right.
bank and the holding company as though that was some big deal. It's not.
That's very
Ignore
misleading.
that. They're misleading you. And
Yeah, and if this were to go to trial by jury, like
they would
that'd
get
be a really tough one.
yeah, you would have to get a jury, and you would have to like explain to them what this stuff means, what's
Right.
reasonable. You would get experts, so you would get people who
Hmm.
worked in treasury or
Right.
who knew interest rates to
Hmm.
try to explain it.
Go into
And then
great
they run to
detail
the
about
problem I'm
this.
having now is that it's not something you can do quickly. It just keeps
Hmm.
requiring
Yeah.
all these several other layers.
Yeah, it's like not only like not finance professionals, but just the general public. Like, I wonder if that would be like having to go over all of these very intricate topics, and then
Yeah,
even more intricate how they fit together. Would that be more helpful to the defense or the prosecution? Like, I'm really not sure. Like, prosecution, like you're saying, you can write something that looks like very damning.
yeah,
But at the same time, maybe that makes it easier for the defense to say, there's tons of reasonable doubt here.
yeah.
I'm not sure. This is brand new. I thought that this came out. I don't know, sometime earlier.
No, I guess not. Yeah, this is brand new. This just popped out, which is why I thought it would be useful to do. Obviously, the case and like so, there were a couple other things. The After a bank fails, the FDIC will write up a report. It's called a material
Hmm.
failure report that'll detail why it failed. That's often kind of the most interesting component.
Hmm.
Most interesting from other bankers, the people in the industry. It just shows you what risks they were exposed to that ended up destroying the bank.
Right.
That came out like at the end of 2023, so that's old news. So like,
Hmm.
so how it failed and why it failed and all this stuff is old news. So I
Hmm.
was not trying like not to cover that so much
Right.
as kind of the case, and specifically are the kind of what the complaint wants to file against the officers and the directors as being negligent and grossly negligent.
Hmm.
And I guess kind of to skip ahead, I would say yes. I've kind of
So,
so
um,
maybe this is the angle to do this. I'll zoom in as to like kind of the couple of the reasons that I found to be the most negligent, and they weren't really honed in by the prosecution. Like the prosecution didn't really linger on this too much, but I think it's what I found to be some of the worst, kind of most egregious offenses. So maybe that's kind of the way to do this. So first off, they had a bunch of outstanding, MRIAs, so matters requiring immediate attentions and matter requiring attention. So this is when regulators will come in, they'll do an exam, so they'll look in detail into the different models and your assumptions and your ALCO decks and what was reported to the board, and they just try to make sure that you're operating your bank in a safe and sound manner. Now, if they find something that's wrong, they'll issue either an informal sort of enforcement action or a formal one. Now, informal ones are not public. That's really the main thing. And those are things like MRIAs, MRAs. And now what they're saying here is like, they ended up finding several, MRAs and MRIAs. So these were not so big as to be formal items, which are things like cease and desist orders, which are like very serious. These are like, you got to kind of tweak this. You got to fix this. That's one of the things. And kind of long story short here is that the officers, they knew about these things now. So there's nowhere for them to hide. You can't say that we didn't know about them. Okay. The regulators told them about them and then they didn't fix them. So that's when the hammer really comes down. I can say as a former regulator is if you issue an MRA or an MRIA and then you only do an exam like once a year, maybe more, depending on kind of what it is. If they didn't do anything to address them, that's when you're like, okay, we got to escalate this. That's when it's like, okay, you got to take us seriously here. This is a real, we're not joking. And they didn't. So that's kind of one knock, certainly in the realm of negligence. One of the other things I wanted to say here is I did not appreciate how it was written in the complaint. To if you're familiar with what the bank did, they had a very large they have a very large securities portfolio. So the securities portfolio itself was like over half of the assets of the bank, which is huge. That's huge for a bank. A bank might have like 10% or something, 15, maybe 20% or something in investments, but to have over 50%, 60% or something is outrageous. But then there's an important accounting consideration here between you can have an investment portfolio and you can categorize it as three different things. I think two are really the most used. One is available for sale, and the other one is held to maturity, HTM or AFS. Now, the way that they are handled on the books is different. So in AFS, what the AFS is going to be on the books at the market value. Okay, so like if interest rates go up, that's when you're going to see the AFS portfolio. That's when it goes down. Right, on the asset side, that number goes down, and then it gets a hit to equity on the sort of liability and equity side. Now, HTM, they are not on the books as the fair market value price. They're on as amortized cost. So what that does, it insulates the bank from swings in the market value, right? And so what I didn't like, I didn't like how this was written, and they do this. Whoever wrote this do this several times throughout the complaint, in which they keep suggesting that they were used HTM rather than AFS to obscure some of the potential adverse consequences. They kept saying like, oh, they kept putting an HTM to obscure what the real value was, when there's nothing against GAAP accounting rules. You do that. That's the whole point. That's why you do it. They weren't trying to like hide it. They just wanted to insulate themselves from these fair value fluctuations. Now, the thing about that, if you do that though, it means you can't sell them. And if you start selling them, what an auditor might say is like, look, you're selling your HTM book. They're not really HTM, are they? You have to turn them to AFS. That's so you have to hold on to them. And so I didn't I didn't like how throughout this thing they keep talking about like unrealized losses in its HTM portfolio as though they're
Yeah,
like
like I was
hiding
going to say,
something.
like, was there any evidence of them doing something like that, or where
Doing
it
something
talks
like
to
what?
the HTM, but then actually selling it? So like
No.
actually
So
classifying?
no, you would see later that like management discussed potentially shifting some of the portfolio from HTM to
Right,
AFS or selling the AFS portfolio.
right.
But you
But
can't
like
just
they
like
never like
sneakily, you don't just
misrepresented
sneakily. Fraud is not, let's put it another way. Fraud is not, accounting fraud is not something, it is not one of the cases brought against them. Let's put it that way.
it. Interesting.
And I didn't like how they kept referring to these unrealized losses as though they're trying to hide something. They didn't, there was
Mhm.
nothing, you know,
I mean, like effectively every bank in the country at that time was
yeah,
having
this is just
effect on their
standard
ATM.
gap accounting. Um, so, and this is right here is kind of what I just explained a minute ago. So you can't sell them. So part of the deal with HTM is yes, if interest rates rise and the market value goes down, you don't have to take that hit to equity, but it also means you can't sell them. um, um, so this is my point earlier, just saying that they were an extreme outlier regarding the relative size of its HTM securities portfolio. So they were saying like it was like 78% HTM, which is very high. One of the things they don't mention here, which I think is even just as important, is just the fact that the investment portfolio itself was so big relative to its assets, total assets. Okay, I want to get to really what I think is the worst, was the worst offense, and also kind of the most interesting. You got to go. Maybe I should just let you go. We should just axe this, like do it later or something.
Um,
Um,
totally up to you. If you think you can.
I'll just make this one other point. Although I don't think I'm going to put this one up. This has been too much of a show of an episode. Um,
I mean, I think not. So we definitely are, on the fly discussing how we should be doing it. But I mean, I think we can use,
we can use some of it.
definitely a chunk of the intro, and then like my idea is like if like at this, like right now, come up with some sort of pivot to kind of wrap things up of what we did talk about, and maybe leave it open ended about this other aspect of it or something
Okay.
like that. Because yeah, like I definitely don't want to say this is a failure. Definitely not that. We're just you got to we're still just
Yeah.
figuring all this out.
Still figuring this stuff out. But this, I knew when I was like putting this together, this was a lot of material. But I didn't realize it was this much because I didn't really respect. I didn't think I would be having to explain interest rate risk and its theory just real quick. You could have like whole. I mean,
Yeah.
people
No, I
people
mean
take
that's
whole
what.
courses. People take like whole courses on this stuff, and we're just like,
Yeah,
oh,
no,
real quick,
definitely.
this is
And
what's going on here. And
yeah, I mean this is your background, for many years now, and like from that perspective, I think it'd be really interesting, like if we
yeah,
were to do an episode where you just kind of go through a play by play with how
I
the event
had
itself happened,
for
and maybe that
whatever
can
reason.
help
For whatever
contextualize.
reason, I thought it would be enough just to explain the bond price and yield consideration. So what you were explaining, you explained it last time, and you explained it
Mhm.
briefly here. But to actually see the numbers has a big deal. So there was like that point: interest rates go up, price goes down. But then also the longer the duration, because they spend a lot of time talking about duration here.
Mhm.
Just the longer duration of the asset, the more sensitive it is to changes in interest rates. That's really the point. And you can actually just show that uh, with like examples and math and stuff. So,
Math.
all right, but let me get you to one of the most what I thought the most interesting case was, and this is kind of bringing it around, was the fact that one of the things they need to remember is that the interest rate risk team, so the actual like the risk management problem, didn't seem to be the problem. Like they were properly measuring it. They seemed to be on point. So like right here, what they're saying is, look, you're blowing through your metrics. Okay, it was accurate. So like I don't want to lay the blame on the on Treasury essentially. whoever was running the models to try to calculate what would happen to EVE if interest rates rose.
Mm-hmm.
But here's the thing. In November 2021, in the ALCO committee, Beck, so I think that's the CEO, had reported that SVB had been out of compliance for EVE at risk for several months. And then he asked what additional actions could be taken. Now, Cruz, so that's the treasurer, responded that one way of improving EVE at risk was to change the assumptions used in the FVB's deposit model. So thus, rather than mitigate the actual risk, by taking whatever steps necessary, they basically just proposed to change the models so that it wouldn't show a breach. And they would change it by doing changes to assumptions.
Right. Which can be a perfectly legitimate thing to do.
It can be. And so this is, I think, one of the things I talked about later was like, these assumptions are going to be closely, one of the things that's expected in a risk management program is that you show to the governance. So that's going to be ALCO, for example, your assumptions. And if you want to change one, you need to justify it. You need to go up there and explain why you think it's prudent. Why is it reasonable to change this assumption? They didn't go into detail as to what the argument was. Yeah. So this is what they did. And they brought this to the board, and they said a report providing for mitigation of interest rate risk by managing EVE sensitivity through deposit modeling. And what they wanted to do was to alter the deposit model's curtailment assumption, which is the overall time that deposits remained with the firm. So it's it's not a term I'm familiar with. Curtailment assumption. You can use decay rate, or you can just use the average life of the deposit, whatever it is. But as I mentioned earlier, with interest rate risk, when you are trying to model a bond and to see what happens to the price of a bond if interest rates go up or down, it's very easy because the cash flows are fixed. You know exactly when the cash flow is coming and what it is. With deposits, if you want to try to put a present value of those deposits, there are a lot of assumptions that you need to go into this because you have no idea what the cash flows are going to be, right? Like if you just have like $100 billion in deposits,
right?
And these are just people with like transaction accounts, money's flowing
Right.
in and out. And like, there's kind of some understanding that on average, a deposit, might live for 10 years,
Right.
12 years, 4 years. You just don't know what the cash flows are going to be.
Right.
So you gotta put in assumptions. And that's like a key assumption.
Things and see what they were in the past. And, that could be a reasonable assumption for the future.
Yeah.
But the future can always change in drastic ways.
Yeah. So now, so that is why, typically the average life of deposit is a very critical assumption, because not only is because you're talking about the vast majority of your liabilities are going to be this one product, right? So you could just move that number a little bit and it's going to change the outcome of your interest rate risk a lot. And that's what they did. They literally, I think, doubled the assumption from 5.5 years to 12 years.
Okay.
And then all of a sudden, oh, look at that. We blew through all our limits, and now look, we're inside it again. That to me is like the most, like, again, I don't have the justification. Like if they went out and they got like a third party to come in to the bank and do like their own analysis as to what was going on with their deposits. And they said, oh, 5.5 is way too short. It's more like 15 or it's more like 20. And we said, okay, we'll be conservative. We'll take the midpoint. We'll say 12.
Yeah, and looking at
then
this,
it's like,
this is
like,
March
okay.
2022, right? Looks like.
Huh? Yeah. 2022.
So that's when the rate hiking campaign began.
So this is the thing. This is the other important thing you got to remember here. They're blowing through their limits through all this time, even though interest rates didn't move. The point of interest rate risk modeling is the what if question. So what this is, they're saying at 100, assuming there's a 100 basis point increase, what happens to your EVE? So it doesn't really matter from an interest rate risk because these are all hypothetical situations anyway. But but you're just looking at, what is the, how have I been managing my assets and liabilities? how much exposure do we have to interest rate risk at any one time? And they had a whole bunch of exposure all throughout this time, and they knew it. And then, once interest rates actually rose, and they were exposed to it. But, the other thing I wanted to mention here was, like, I'm sure that management saw this and they said, well, look, we are aware of this risk, but how we're going to solve it is what? we're going to classify them all as HTM, and then it's not an issue. That's probably what they were saying.
Yeah,
they don't say it here.
This was like March 22. I think that is an important date, though, because this is before early 22. We were back in a world at zero interest rates, and people thought it was going to be like that indefinitely. There was no reason to believe inflation hadn't perked up yet. There was no reason to believe it wasn't going to be just like the previous decade, like literally. So a lot of the decisions, like your whole mental framework for how to manage this stuff, really changed drastically.
Yeah.
At this time period, like early 22, and the first rate hike was March 22.
Yeah. So no doubt, if nothing else, certainly the new analysts will be looking at this a lot closer, because mm-hmm. I did pull the 2021 10K, and I saw what they disclosed. Like, they disclosed these numbers to the SEC filings. And yeah, they showed some really big negative EVE numbers. And then when they actually published the 2022 one, they actually got rid of them. They did not disclose them. So they knew exactly what they were doing. And I think
now, is that a function of this
let me just
change?
Let's just it's a function of what?
Of changing that
no, this is them covering it up, because I think it went back down to here, quantitative and qualitative disclosure about market risk. Oh, so this is for 2022. Yeah. Yeah. So so this is the kind of what they're showing for the numbers as of December 31st, 2021. So I guess this is kind of poorly labeled. This is going to be the report that came out in 22, but it's for 2021. So apologies. But you can see right here, we're looking at their disclosures for, EVE, and then you can see the percent changes. So if interest rates go up by 200 basis points, they're saying that the economic value of equity, so kind of the equity of the bank, is going to go down by almost 30%, which is way past anyone's limits. Now, they disclosed this. But as I was saying earlier, kind of what people are really like to see are these numbers, so that increase and decrease in NII. So if interest rates go up, they are going to have an increase, and a pretty significant increase, in net interest income. So they are asset sensitive. That's kind of what you want to see. But my point is, for the year 2022, so this is the 10K for the year. So my dumbass, here it is, for the fiscal year ended December 31st, 2022. And now the same section, they barely give you anything. So this was a conscious decision. Like, they knew that this was bad. And this probably would have been published, at the beginning of 2023. So this to me is quite damning. They don't even show you the EVE numbers anymore. And they had taken steps here to artificially, again, we don't know what the justification was.
But they made this change, and then shortly after, they were outside of the limit again.
It fell anyway. Yeah, that's the other thing. They made the change, and then it still went back down.
Kind of hopeless.
I don't know what. So yeah, something's going on.
Yeah, I mean, I think it could be just related to the drastically shifting
So yeah, here
interest rate environment.
this is what the actual.
Sorry, Luke. It's almost 8 o'clock. I really do need to.
Yeah, sorry, dude. All right.
I'm
Well,
far
anyway,
over.
that's it.
But yeah, let's try to do like a I don't know, transition into a follow up episode or something. I don't want to end so abruptly.
Yeah, I don't know. Don't worry about it. All right. Hey, man. Well, sorry about that. Thanks for sticking with me.
Definitely, this is super interesting.
This is super interesting. Yeah, I think anyone else
this is
in the
probably going to be
space.
in the news.
It is in the news. That's how I discovered that this came out, and then I went and found the actual thing and started reading it because we use primary sources here.
That we do.
All right, man. Thanks for sticking with us. You two at home. This was an interesting.
Tuning in.
Yeah, this was
as always.
All right. At the Root of All Evil podcast. There you go. Top notch, high quality programming.
We've got the brain power here.
Yeah.
All right. Well, see you next time.
Yeah. See you next time.
Thanks for tuning in. Smash that like button.
All right.
All right. See ya.
See ya.